Welcome back to the show. I hope everyone has had a great week. This week, I'm going to talk about how drastically I've changed my portfolio and therefore my investment strategy. I'm also going to talk about some big news relating to that of Boohoo, potentially quite big for investors. I'm also going to be talking about the other holdings. They've had some updates too. And don't forget, I'm also going to be talking this week about what I've learned from the pandemic sell-off. Firstly, this week, Ashtead Group, one of my smaller holdings, has actually created a new division in their subsidiary Sunbelt Rentals UK, focusing more or less on safety and communications, which I think is a good move. I like this company to be more diverse, and it's my defensive dividend growth stock. So if they're able to do this, keep their revenues going, have some year-on-year growth, and I think this is a very defensive sector to be diverse in with their division. I think that this is going to need consistent demand, and even in a recession, people are still conscious on safety and communications, as people are still going to want to buy gas detection devices, breathing apparatus, and radio communications equipment. I'm glad they've done it. It makes it slightly more of a defensive holding and also diversifies their income streams furthermore. With this in mind, the stock's increased around 2.55% the last 5 days, which isn't great considering the market has done about 3.1%. I consider Ashtead to be one of my more defensive positions and will continue averaging into this position. Hopefully, eventually it will make up around 10% of the portfolio and I'll be satisfied. The other defensive position in this portfolio is a company named Halma. I've spoken about them before. They're a technology company providing solutions in the safety, health, and environmental markets. Brilliant company to own as they acquire these other companies in these sectors, rebuild them, make them profitable, or further increase their profits and continue to grow. And they had released their final report on July 14th for the year, and it's actually pretty good news. They'd grown their revenue by another 11%. All of their sectors had also shown increased revenue growth. They've also grown their earnings per share by 9%, which is great because it means that there's going to be some capital appreciation there if they keep growing at that rate. And for the 17th consistent year, managed to produce record high profits. However, with this in mind, they are concerned about the pandemic and its impacts on the business, and they forecast or suspect that their growth or earnings is going to decrease in the next year from March of 2020 to March of 2021, and they suspect that they're going to lose about 5 to 10 percentage points in that regard. However, despite this, they've announced their dividend for the 41st consecutive year of growing it of over 5% each year, which is impressive. Whilst lower than the years before, I still think this is brilliant. They continue to doing so, and they're still highly profitable. Great company to own, and I'm going to be averaging more into this position in the future as it is a small spot. And providing that Boohoo has started to recover, then my money will be going into Halma, fleshing out this position and then building up my other stocks that are a little bit far behind. I want to hold less overall stocks, and you would have noticed that over the course of my portfolio, I have cut down. I had around 13 to 15 different stocks, and now I'm dropping that. And this is because I want to be invested in what I know, so that I'm more likely to outperform the market with smaller groups and generate therefore more returns in the future. I'm no longer going to limit myself to a specific strategy such as dividends, value, or growth, but instead I'm going to look to combine the three strategies and therefore try and build a best portfolio I can, getting the best of all worlds. So I'll have a few stocks dedicated to dividends and dividend growth, for capital growth, and also some value stocks. And yes, I know that over the course of this portfolio update, I have looked extremely confused, but I'm hoping that this replicates what a beginner investor would also do, and that they would also invest in oil, penny stocks, and then also start to formulate their strategy as time goes on. I'm hoping that I've gotten that all out of my system early, so that now I can look towards catching back up to the market and subsequently beating it in the future. Although I am trailing the FTSE 100 and 250 by 9%. Before talking about the biggest news of the week, I'd like to talk about one of my positions that I've sold. One of them is WHSmiths. I'm extremely bullish on the company, and that hasn't changed. It's a retailer that benefits from increased travel demand as they are deciding to put their stores in travel hotspots such as airports, motorways, service stations, and many other places. They've also acquired 2 companies in the US and plan to grow there. Fundamentally, I think this company has great opportunities for growth, but I did sell my position of 55 shares. And I sold this because I wanted to reinvest this into other companies. Whilst their high street stores are slowly decaying, I decided that, you know what, it's a great company, but for the for the short to medium term, I don't think they're going to see much capital appreciation and stay relatively stagnant until we see perhaps a vaccine or the pandemic kind of dissipating. Sell out of that position, reinvest into Boohoo, because I feel that Boohoo's news and the reason its share price is so low is based off of short-term sell-offs. And in reality, I think that this can recover very quickly and a lot quicker than that of WHSmith. Plan was to reinvest into WHSmiths once Boohoo was no longer heavily discounted, in my opinion. However, I do feel like I want to balance my portfolio evenly between dividend, value, and growth. And for this reason, I already own Aviva and Redrow, which would be my two value plays. And it just means that I'm kind of reducing my overall equity in each of these individual positions because I'm opening more spots, and therefore it could reduce my returns in the long term. I'd rather have a concentrated amount of equity in a smaller amount of positions so that I could potentially gain a lot more. As obviously I will be now diversified with two retailers if I rebuilt that Smith's position. They sell to different audiences and niches. However, I'm looking for a very concentrated portfolio. It's excellent dividend history, I will give them that, but otherwise I'm going to be so overexposed to the retail sector. And I want to trust my ability in choosing these stocks rather than diversifying so far out that if I did choose a good stock, it would only give me 1% returns on my overall portfolio. I still believe that you can get great returns from holding this stock, although I feel that I'm still diversified elsewhere in the same sector, and subsequently I had to cut the position. Diversification is very important if you don't believe in your own ability to select the best stocks in each area. And in fact, if you know so much about a particular niche or sector, then it's kind of pointless diversifying. If you know exactly why 5 companies in the technology sector are going to grow, outperform the rest and do extremely well and therefore generate you strong returns in your portfolio, then why would you go and invest in energy as well? If you know what you're talking about and you know the niche, there's no point diversifying. But I do understand diversification from an idea that if you don't know too much about your companies, then yes, you are reducing the overall risk. However, if you do understand this, then it seems silly to have all of these extra positions. And in fact, I think my portfolio really reflects this idea. I have Games Workshop and Boohoo, in which I would be part of the target customer base. I understand why Games Workshop is doing so well. They have that audience who are willing to buy these products no matter what. It's like a legal version of drugs, and they will keep buying this. Warhammer is such a big universe, and people love to escape into it. Boohoo sell very cheap clothing for people my age and above, right? This is very trendy fashion. Also, Redrow. Also understand the property market. As an aspiring real estate agent, I looked quite a bit into the housing/property market, as well as construction. I'd looked into these construction sites and I'd been present on some commercial construction sites as part of my understanding and improving that. So I understand why Ashtead Group, subsequently Sunbelt Rentals, would be making such a nice amount of money, because they are going to be renting these big pieces of equipment or purchasing it off them. So I understand the companies in my portfolio, and therefore I don't feel like I need to diversify into other companies like I previously owned, such as Tesco. Yes, I understand it, but I also understand why it's probably not going to do so well in the future. Another 2 of my defensive companies, which I know last week I said I would like to take up 10% of my portfolio, I have sold. And in fact, these are still brilliant investments. And if Freetrade adds SIPs to their application, then they're likely going to return. SIPs are self-invested pension plans. The idea would be that if they added SIPs, I would have an investment of more defensive dividend companies such as Diageo, Unilever, National Grid again. I'd bring them back, as then I wouldn't be needing this until I'm very old, because I wouldn't be able to access it, and therefore I would go for these more defensive stocks and let it just build up wealth slowly. I sold Diageo at a loss of £11. I sold 25 shares and I was down roughly 1.41%. And I also sold 7 shares of Unilever, in which I was up 3.74%, which is also around £10. So effectively I broke even between that minus stamp duty. So yeah, I am at a loss somewhat. I just felt that these are great companies, but the diversification I don't want currently. And whilst yes, I did sell these companies at an effective loss, Smiths especially, as I did lose about £40 to £50 on that overall investment of around 600. But it's okay to sell at a loss, because I planned, and I did, reinvest at another low. So yes, I sold at a low, which is the meme that they would commonly say would be, oh, well, average investors sell at a low and buy at a high, and therefore they don't make much money. Well, yeah, that's True, but I sold it at a low and also bought it at a low because I felt that Boohoo was at a significant discount to its recent highs. I think it's going to perform better over the long term. Only 40% of you watching this video right now are subscribed. So if you're interested in my UK stock journey, my stock picks and my stock analysis, then please consider subscribing as it is free. Thank you. Firstly, there's an analyst prediction on Boohoo, and they're predicting that Boohoo could move 40% of their factories currently overseas. That's to combat the controversy surrounding Leicester and the poor working conditions. They also predicted that profits will fall by 30% in 2022. And Credit Suisse, the same people, slashed their price forecast from 440 pence per share to 250 pence per share, which is quite a low blow. And I'm going to be very honest about this right now because it seems like analysts make these bold predictions as to get recognition, but then if they make a prediction that's incorrect, they subsequently just get forgotten about by the media. But if they make a correct prediction, something bold, they'll be remembered for the rest of their lives. You would remember them for going, oh wow, he shorted the banks then, but then he's also made so many different incorrect mistakes. So if they're correct, they're hailed as some kind of oracle. Yet if they get it wrong one year, they'll just be forgotten about and they'll keep making more predictions and until they make a correct one. How the f did she get the conclusion that Boohoo's profit is going to drop by 30% in the next few years? Like, where did she get this information from? This issue is only a PR issue related to the UK. I'm pretty certain that the US or Europe, markets that they are also exposed to, have no idea about this PR related incident. They've got their own problems to worry about. And they're going to probably continue to grow. Remember, Boohoo is a company that isn't doing well because of its low operating costs. It's because of the amount of sales they've had and their revenue growth. However, I'm not going to completely dismiss the opinion of this analyst, as they may move their factories abroad, but using their business model, they can afford to do that. If they had 2% of their factories in the UK, they can use their business model of test and repeat. They'll put their products online. The ones that sell the most are their test, right? They've tested that sold loads. Then overseas, subsequently in another factory, they will produce loads of these clothes and ship them to the UK, the US or Europe, wherever they need to be sold. And therefore, it doesn't matter if they move abroad. Yes, obviously it will affect our economy subsequently, and it's not great, but for the business, it shouldn't matter that much. Also, during this time period, the directors / the founders of the company have bought 15 million worth of their shares, and people are speculating, oh well, it could be to reboost investor sentiment. Probably not. They can tell right now that this is a good discount for their company and they're buying it at such a good price. If they wanted to boost investor sentiment, all they have to do is use their words. They need to say, look, we're deeply investigating this situation and we strongly believe that we will continue to grow and overcome this situation, and that I'm not going to go fully into it, but that's all they have to do. But they're buying shares. They see this as an opportunity. And the fact that they've remained pretty quiet gives me the impression that they're trying to take advantage of this opportunity as well. And if they're buying, is it really that bad? I very much suspect that the media will continue to slander this company to get easy clicks. Who clickbaits in 2020? Well, as of recording this video, another article has come up by the Guardian suggesting this. Boohoo could be forced to move 40% of its production out of the UK. And it's yet another article trying to spook investors. And do you hear a similarity here? It's talking about the same analyst making a prediction. Why does this matter? Why do you need to hear what analysts have to say in order to be invested in a company? It's yet again trying to spook investors and shake the tree. They're trying to hit stop losses and they're trying to get their own money. Maybe they're shorting it, or maybe they're going long on these great value prices. And once they no longer get clicks, where are they going to go? They'll likely move on to the next topic. Remember Dominic Cummings? Well, I've not heard as much about him in recent weeks, and that was a fairly big scandal. The founders of Boohoo know very well that there is serious money to be made when there's blood on the streets. And as Warren Buffett has said before, it's like buying $1 for 50 cents, not the wrapper. And I think this is a significant discount to purchase such a wonderful company that is likely going to continue to grow and perhaps even compete with the likes of Amazon. I'm also going to stress the importance of a cash position, as it is something I've learned. If you've got this money available, you are less likely to jump on the fear of missing out. because you know that there are opportunities waiting at all times. You don't necessarily need to take the first train you see. What if you wait for the next one? This first train might be taking you down a different destination than the second one. And I likely wouldn't have been able to acquire as much of the Boohoo stocks as I have if I didn't have some cash position on the side. I know I did sell some of my other investments, but I wouldn't have as big of a position now, and I feel that I will make some serious gains from this in the future. And since I have sold out of a lot of positions, used the remaining amount of my cash position, I've managed to build up serious equity in Boohoo, and it takes up 44.8% of my overall portfolio. I know, I thought Red Row was bad, taking up around 27%, but this seriously is the icing on the cake. And whilst this could be extremely risky, very insane, well, at the time of my age, this is 40% of my net worth. I have a chance here to rapidly increase my net worth, or I lose 40% of my net worth, and I could probably earn this back in the next few years with relative ease. It's a mistake I could learn now, costing me a lot less than it would in the future. But if I'm right, I have potential to double or triple my current position size. I own 1,750 shares at an average share price of £2.45 per share. I've been buying since it dropped to £2.97 and below, and I've managed to average it down that much. And if the share price continues to stay stagnant, I'm going to keep buying. I'm currently down minus 6.34%, or the equivalent of £271. However, earlier this week it was a lot worse, and I was down 14%, subsequently £600. And if Boohoo do return to their recent highs of 400 pence per share, I would be looking at around 75 to 80% return on investment. And it is very, very, very important that I don't delude myself in this process. Yes, I could make a lot of money, and if I do, I shouldn't get overconfident about it, because it's very likely that with this overconfidence, I'm going to believe, look at me, I'm this brilliant investor, I'm going to make money, I know why, I'm going to invest in this company, I don't care for, oh no, it's a value trap, go away, I don't care, because this is my opinion, and I'm always right. That could corrupt an investor's mind and lead to, subsequently, a downfall in their charisma, as well as their overall returns of their portfolio. And I do feel that you're going to be less likely to listen to other opinions if you're so overconfident in your own abilities, and therefore making you quite naive. Interestingly, Games Workshop has been the top performer this week, returning 7.47%. This is likely due to both an increase in investor sentiment and the market rallying very much over the idea of Moderna producing a potential vaccine, and also Oxford backing this up, as Moderna had a successful phase 1 of the clinical trial. Viva also gained 2.63%, which is about the same as the market, and I am still very much waiting on the update in August, as this is when I will know what they will do with their dividend and what their business strategy is. Will they completely divide the companies, or will they increase the fundamentals? That's what I want to know. If I don't agree with it, I'm selling out. Red Row has been fairly stagnant this week, dropping by 1.81%, and it goes to show not all share price changes relates to news, and in fact I don't think there's much news on it. It's likely people pricing in what they think of the current economy and the housing market. I'm not planning to add to this position in the near term future, and I think that by the end of the year it could easily hit 650 pence per share. And if you're interested in my Boohoo stock analysis, then please click the card at the top right of the video. Thank you for watching. This is the Ozbourne Foreman Show. See you next Tuesday at 4 PM with more stocks to buy.